This class will be concerned with portfolio analysis. Now, portfolio analysis relates to an analysis of the assets of the business. It looks at what the business owns in terms of the physical assets, the premises, the machinery, the furniture, the fixtures and fittings, the vehicles and so on. It looks at the products that the business owns and the services it provides, and the wider resources that belong to the business, for example the cash and the financial resources. And it looks at this portfolio of resources and tries to optimize the portfolio, optimize the return on the portfolio. So the task is to get the biggest return for the portfolio of assets. It looks at the composition of the portfolio and how the various assets are employed. It might want to move around the way the assets are employed. Perhaps there is too much cash in the bank and more investment would yield a higher return. Or perhaps there's too much investment and there needs to be some disinvestment in some areas. It depends. But it needs to optimize the portfolio. It needs to get the biggest return on the collection of assets that the business possesses. Generally, it considers the market share and the growth rate of the market. These are two key indicators. And generally speaking, it tends to look at these to assess to what extent the individual asset components are performing well or not. A successful portfolio develops the strength of the business and exploits any market opportunities that may be available, that the business can work out or can see. So the successful portfolio develops the strength of the business and is on the lookout for new opportunities. Now, portfolio analysis allows the company to analyze their current position in the market and develop strategies to exploit opportunities. So portfolio analysis has that as one of its key attributes. This is what it does. It enables the business to assess its current position in the market and develop strategies to develop new products and new opportunities. Secondly, it manages the growth and decline by careful analysis of the resources of the business. It carefully manages the growth of the business. It doesn't overgrow or develop too quickly, which may put stress on the financial resources, on cash flow, for example. So it allows the business to grow at a managed rate. And also it manages the decline of the business if the business, of course, is declining. There are two methods used for portfolio planning. The McKensey General Electric Matrix, the DGD Matrix, and the Boston Consulting Group Portfolio Matrix, BCG. Now, the Boston Consulting Group material is presented in a different video, in a separate video, so we won't go into it here. We instead will focus in on looking at the methods required the business to identify the strategic business unit, and we will focus in on specifically on the General Electric Matrix, the GE Matrix. Here we make reference to SBU, the Strategic Business Unit. This is a unit of a company that has its own establishment, including a separate mission, objectives, and which can be planned separately from other businesses. So an SBU is a separate part of the business. It's a separate function of the business. It may be a department, it may be a functional department, it may be a product. maybe a product that can be classified in the market and seen in the market, and that becomes the strategic business unit. So we talk about strategic business units as the items that we are particularly focusing in on. But as I said earlier, we're going to look at the GE matrix. So let's look at this. McKensey and Company joined General Electric to develop a 9-cell portfolio matrix, which was used as a tool for monitoring General Electric's increasing portfolio of SBUs. General Electric was expanding rapidly and increasing its portfolio of strategic business units, its portfolio of products, for example. So it needed some way of being able to assess the performance of the products and look at the products analytically. The aim of the matrix is to map out the strategic business units on the grid of the industry and determine the position in the industry. So the whole idea is to get a visual picture of the SBU, of the product, let's say, and see where it is, where it fits in terms of the overall industry. So we may have a matrix of that form. We have industry attractiveness on the vertical axis and the strategic business unit along the horizontal. And inside we have these 9 grids, these 9 cells in the grid. We have low attractiveness, industry attractiveness, going to high industry attractiveness on the vertical axis, and on the horizontal axis, high business strength of business unit and low strength of business unit, and intermediate, of course, as well. And for each one, to simply fill out grow, hold, or harvest. Now let's talk about the industry attractiveness. Well, the vertical axis on the matrix is the industry attractiveness, which is determined by the following elements: the rate of growth, the market size, industry profitability and competitiveness, global opportunities and opportunities to differentiate, environmental factors, segmentation, distribution structure. Now let's go across these very quickly. First of all, the attractiveness must be related to the rate of growth of the market. If the market's growing fast, then the chances are we could see the potential for growth in a particular sector. The market is growing, the demand for the product will grow. But also, what's the market size? If the market is very small, it may be growing fast, but if it's very small, there may not be a lot of potential. And what's the profitability in the market? What's the competitiveness, for a start? How many companies are competing in the market? Because the more companies that are competing, the lower the return, generally speaking. Profit margins are squeezed. So the industry profitability. What is the industry profitability? Because that will be a key determinant in whether the product should be developed, or it should hold at the same level, or it should be perhaps disinvested or divested, so it is slows down or sold off to someone else. And what opportunities are in the market? What overall market opportunities are there? Are there opportunities to differentiate the product? Now this could relate to factor 6 as well, which is segmentation. Perhaps there are different segments in the market. The product may be aimed at different age groups, for example, and there may be a possibility of developing it for yet another age group. So if the product is currently being sold to the 20 to 30 year olds, could it be also sold to the 50 to 60 year olds? Perhaps with some modification. And the environmental factors, well, these could be the influence of government, legislation, local government. It could be trade unions. It could be activists and people who are supporting particular lobbies. For example, green campaigners may be upset about some aspect of the business, or may not. So there are certainly environmental factors to be taken into account. And the last one, the distribution structure, well, the business must be careful to ensure that it has got an appropriate distribution structure, one that's efficient, gets the product to the market, gets it there on time, and is reliable. So, looking at the matrix again, we've got the industry attractiveness, and we now know the backdrop to the industry attractiveness, the sort of factors, and out of those factors we try to assess whether it's low, medium or high. On the horizontal axis, across the top of the matrix, we have got the strength of the business unit. So let's have a few words about that. Well, the horizontal axis of the matrix looks at the strength of the business unit, which is determined by the following factors. The share of growth within the market. So how big is the business unit within the market currently? If it's big, it'll have power. And with power, it may have the opportunity to change the price or change some aspect of the market more favorably with what it requires. What's the brand of the product? Does it have a brand? Does it have an image in the market? Is it recognized by the customers? Do they recognize the brand, and do they associate it with good quality? What's the reputation of the brand? The access to distribution channels. Does it have good distribution channels? Does it have a good relationship, let's say, with warehouses, with wholesalers? Wholesalers may buy in bulk and distribute it on to the retailers, but do the wholesalers look favorably upon the product? And what are the profit margins compared to the rivals? What the rivals may be more efficient at producing the product or a similar product, and therefore they have more or better margins. What's the strength of competencies and assets? What's the strength of the business? What are the core competencies of the business? What can the business do that other businesses find difficult? And what can the business do easily that gives it an advantage in the marketplace? What's the production capacity and cost? How much of the product can it make? And what does it cost to make the product? What's the marginal cost of each unit, if that's possible to calculate? But how much can it make? Because growth will need capacity. Growth can only happen if there is the capacity to produce more. What's the history of innovation within the product? Is there scope for further innovation? Are there plans for more innovation? So will the product change? Will it be more attractive in the marketplace in the future? And what financial assets and investments, and what access to investments is there for the business? Do the banks look favorably upon the business? Does it have a good history of money management? Does it have a good financial history? So do the banks look favorably upon it, and will they give it access to funds if it needs it? So those are the two axes of the matrix. And depending on where the strategic business unit, let's say the product, rests, it could be to grow the product, i.e. invest more in the product, or could be to hold. In other words, just keep it running to see what happens. Don't invest, don't disinvest, just hold, just wait and see. Or it could be to harvest, which usually is associated with a product that's not doing very well in the market, so the business tries to get out of the product as much as it can before it finally dies off. So it's grow, hold, or harvest. Now, for completeness, so at the outset we just look at the general electric matrix, but just for completeness, let's have a quick look at the Boston Consulting Group. It was a model developed that helped large businesses to manage different business units. So it really helps large businesses look at different business units. The matrix outlines various business units on a graph or on a chart, which compares the rate of growth, market growth, versus market share compared to competitors. And that's what it looks like. And this, as I said, has been dealt with in a separate video, but just to bring it back to mind here, since we're here, we have a look at what the various terms mean. So we have market growth rate on the vertical axis, cash usage if you like, and we have low and high, and relative market share, cash generation if you like, along the horizontal axis. So a company that's growing fast and has high market share is a star. A company that's growing fast and has low market share is a question mark. A question mark because it may become a star. And we can go through the same for dogs and cash cows. Let's have a look briefly at what stars are. It's a business unit that covers a large market share in a rapidly growing industry. So it has a large market share in a growing industry. And they require investments to sustain the growth and maintain their competitiveness. Stars will eventually become cash cows when their growth rate slows down and the industry matures. So when the growth rate slows, it'll drop down to being a cash cow. Now cash cows, well, they have low growth rates and high market share. So they've got a lot of the market, but they're not growing very fast. Successful businesses do not require much investment. So they're successful and they don't require a lot of investment. They're not growing very fast, but they have a large market share. They control the majority of the market. They need to be managed to provide continuous profits, which can be used to invest in other business units. So the cash that's generated by this type of SBU may be invested elsewhere in different SBUs, different products, to get a higher rate of return. Next, we have question marks. Businesses or products with low market share but operate in high growth markets. So they have a low market share but high growth markets. Now, low market share and a high growth market, in the market, well, it's a question mark. It could fall and become low market share and low growth. Or it could become high market share and high growth. There are two ways it can go. It can go down to the worst possibility, low market share and low growth, or it can go to the best possibility, which is high market share and high rates of business growth. So depends. These businesses require resources or investment in order to grow the market share. And management need to consider whether these businesses will succeed or fail. They need to critically look at the businesses, critically assess the businesses to make sure that it's moving in the right direction. As I said, it could fall to being the worst, to being a dog, or it could increase to be a star. It can go in either directions. And if you look at the Boston Matrix, the diagram we had earlier, you'll see that it can go either direction. Now dogs, well, almost as the name suggests, these are the ones who are not doing very well. Business units that exist in a mature industry and acquire small market share. So they're in a mature industry, a mature market, and they have a small market share. They require vast amounts of investment to succeed. They need a lot of investment to succeed. And they're really worth investing. They are not growing and they have a small market share. So they're not really worth investing. And the business will be looking, chances are, to divesting their interest in these types of product, in these SBUs. They will look to sell them off if they can. So try to get rid of them. So in this class we've looked at the GE matrix, which is 9 possibilities, 3 growth, 3 hold and 3 harvest. And having looked at that, we then went on to have a quick look at the Boston Consulting Group, which is, as I said, the subject of a separate video. But just to bring it back to mind, we had a look at it here as well. So that concludes all I'm going to say on this topic of portfolio analysis. Let's leave it at that and say thank you for watching.